Hello and welcome to the internal rate of return. So this is the internal rate of return video, and if you're struggling to understand the internal rate of return, we need to go on a bit of a journey really. So that's the way to understand the internal rate of return. So first of all, we'll start with the time value of money, then we'll look at net present value, then we'll look at discount factors, then we'll look at the internal rate of return, and then we'll look at the weighted average cost of capital. I'm going to do it in this order in here. If you're jumping straight into the internal rate of return, we're trying to start here and then work backwards. That's the reason why you're not understanding it. What we do is we go in this order here. So let's start with the time value of money. Money now is worth more than money in the future. There's a time value, and even governments have to pay a time value to lend, even if they're risk-free. And there's also a risk as well attached to the company that has in terms of risk in the future. And so as a consequence, this money in the future that the company is generating is worth less than money held now by an individual in their bank account. So there's a discount factor then that's applied to future cash flows to make them like for like to money now, really, and make them like to like in all the various different years. So we apply a discount factor to these future cash flows. So when we apply a discount factor to these future cash flows and we add them all up, then we get the net present value. So here we have some cash flows, and here we have a discount factor at 10%. We multiply this by the cash flow to give that discounted cash flows. We add them all up and we see what the net present value is. If it's positive, then it's a positive net present value. If it's negative, it's a negative net present value. Okay, so that's the net present value after the discounted cash flows. So what is the discount factor? Well, it's 1 divided by 1 plus the discount rate to the power of the number of years that you go along. So if it was 1 year, if we're in year 1, let's go back here, year 1, this is 1 divided by 1 plus 10%. This is 0.91 times by 1 divided by 1 plus 10%. And that's going on for the number of years. That's the discount factor. The higher the discount rate, the lower the value of those future cash flows, the discounted value of those future cash flows. So if we can reduce the discount rate, then the value of those future cash flows increase. We'll see that later on when we get into the WACC. So what's the internal rate of return? Well, let's take our numbers again in here. And instead what we do is we adjust the discount factor to get to a point where the NPV is 0. So here it was at 26%. It was 25.7%. To get all these discount factors to be that, to get them to be 0. And you do that with a bit of trial and error to get the figure that's required. So the IRR is where the internal rate of return is where the NPV is 0. Okay. So what is the discount rate for the NPV? So if we go back to the net present value, there's sort of the 10%. Well, what actually is it in reality? Well, it's the weighted average cost of capital. So it's the weighted average cost of capital is the discount rate that's applied to is the average return over all of the sources of capital, the weighted average return of all the sources of capital available to the company, with debt, shareholder returns, rentals, supply credit, whatever else it is there. Though, well, it's the return that's required from all of these sources of capital. You add them all up, multiply them by the rates, add them and have a weighted average cost of capital divided by the total to create that discount rate that's required. So it's driven by the risk of the company, the capital structure, and the underlying time value of money. So we've got then the NPV, which is has a discount factor, a discount rate in there. That discount rate is the weighted average cost of capital, and we got the IRR, which is another net present value calculation, where we're considering, we're trying to just get the net present value to be 0. So let's now extend it out a bit. So if the WACC's the required rate of return for all the sources of capital, and the IRR is greater than the WACC, if we undertook the project, so let's say the WACC, all these sources of capital require 10%, and we've got a project and it's going to have a 15% IRR, then it means that if we undertook the project, the value of the company would increase. We would get the cash flows that correspond to this 15% IRR, but we only need to make 10%. Yeah, so the shareholders would see a net present value, a positive net present value for what they require, and the value of the company would increase by those cash flows. Alternatively, if the IRR was less than the weighted average cost of capital, then the value would decrease. And so what's happening here is the weighted average cost of capital is the hurdle rate required for the company, and the IRR is the rate of the project that you're going to compare to the hurdle rate. if the project has the same risk profile as all the rest of the company's projects and does not change the weighted average cost of capital. Now, you could extend it too, and we'll see whether a question might sort of then drift into the weighted average cost of capital. I think that you could look at reducing the discount rate by reducing the weighted average cost of capital. And then that would lead into the traditional theory of the weighted average cost of capital between debt and equity and leverage in the company to reduce the weighted average cost of capital. And then it increases when it gets to a bankruptcy risk. Particularly, Miller is saying that traditional theory is naive and trying to do their economic equations. Theoretically correct if it had perfectly efficient markets, but then as soon as those markets break down, then Migliore and Miller's theories break down. And then how it works in practice, which is really there's a whole different set of sources of capital that have advantages and disadvantages in particular circumstances. So you build a book of capital to achieve the lowest weighted average cost of capital. There's a whole video done on that. So hopefully that was helpful. I think the thing that you need to understand to get the IRR is you need to go on that journey between time value of money, then net present value, then discount factors, discount rates, then you've got the IRR, and then you've got the weighted average cost of capital, and comparing the IRR to the weighted average cost of capital and see what works. Hopefully that's helpful. Thanks for listening. Bye bye.